The housing market's going to crash. Recession, record high interest rates. I'm sure you're hearing all those things, yeah, if you're listening to the news, and a lot of people just out there talking. I'm Kenny Schaaf, and I'm here today to talk to you a little bit about each one of these items and how it's going to affect the housing market and the mortgage industry. All right. So inflation. Inflation currently is over 8%. That's a pretty high number. It's nearly the highest number we've had in 40 years. So it is a real number. Inflation is, again, it's over 8% based on the consumer price index. Now, inflation in real terms, it's probably much higher than 8% on a lot of our things. Um, let's look at groceries. You go to the grocery store, you used to get 4 bags of groceries for $100. Now you're maybe getting two. Gasoline, we all feel it there, right? So what inflation is, it's the arch enemy to mortgage rates, first of all. Mortgage rates are done on a fixed rate in most cases. So what happens over that 30-year time frame is it's a fixed payment. So as inflation goes up, that fixed payment is eroding away. It's able to buy less and less goods. So that's kind of a dumbed down version of the inflation, and help you understand a little bit. Now we all hear about Fed hikes of the fund rate and balance sheet runoffs. The Fed hikes, they've already hiked the Fed fund rate by 25 basis points. And all indications are it could go up to 3% this year. Now, mortgage rates normally respond favorably to these fund hikes. Now, the balance sheet runoff, what that is the Feds, they have 10-year treasuries, 10-year mortgage bonds. These are out there. They're fixed a finite number of time. And what they have been doing for quite a while is, as those are expiring, they were reinvesting them back into the market. They've got over 3 trillion of these right now. Now they're talking about running that off. As these expire, they won't be reinvesting them, and that will slow the economy. Now, recession, that's a word we're all hearing about. And recession is defined as the gross domestic products, the GDP, reporting negative for 2 fiscal quarters in a row. We just had one, so we're going to see if we're in there. So let's look at the history and see a pattern here that I want to point out to you. In the 70s and 80s, you had Fed chairs Burns and Volcker. Inflation was at 7%, then it went to 14%. Mortgage rates were at 12%, and they went up to 18%. Now, you think the 5.5% that we're quoting today is high? You imagine me coming to you and saying 18%? You'd look at me like I had 3 heads or something. But the Feds, they raised their fund rate from 11% to 20%. Inflation responded by going from 14% to 5%. Mortgage rates went from 18% to 12%. And the consequences of that was the stock market lost about 30% of its value, went into a recession. Alan Greenspan, let me move that off of here. Alan Greenspan, inflation was at 1.75, went up to 3.5. Mortgage rates went from 7% to 8.5%. The Feds, they took the fund rate from 4.75 to 6.5. Inflation, they went from 3.5 to 1%. Mortgage rate response went from 8.5 down to 5.5%. S&P lost 50%. Recession. Jerome Powell, our inflation has went from 1.5% to 8.5%. Pretty substantial increase. Mortgage rates went from 2.5 to 5 and 5.5. The Feds, they're talking about going up to 3% on the Fed's fund rate for 2022. So the inflation response to that, if history repeats itself, it should drop. Mortgage rate response should decline as inflation declines. Stocks are expensive right now. We all see that. And we've all heard of a lot of losses in the stock market over the past week or two. Market corrections, economy slowing, another sign of a possible recession, right? Now, when the Feds hike these fund rates, and they do these runoff, this is what it normally does on the interest rates. So if you look here, this was December of 15, rates were going up. They hiked the Fed rate by 25 basis points. Rates went down. You go over here to October of 16, rates started climbing back up, and then they did another rate hike, and of 25 basis points, rates went down. Started to go up again, down. They did a hike, they go down. Same thing here, another 25 basis points. Now, when we got to here in October of 16, October of 17, the Fed started doing a runoff like they're talking about doing now. So interest rates started going up. You can see the rates started climbing up. They did a rate hike of 25, didn't really affect it. They did another rate hike of 25. It started to go down a little bit, but it couldn't sustain it. They were going back up, did another rate hike, and then again, the last one in October of 18, they did a fourth one, and this time it kind of took hold. So it was a full point. It went up. Rates, the runoff started to slow down, starting to go down. Then the rates started to go down. There was a little spike in the beginning of 19. They did another 25 basis point hike to bring it back down. Runoff stops, slows, and then stops. And as you can see, it's all went down from that point. Now, inversions lead to recessions. And what I'm talking about that is your 10-year treasury minus your 2-year treasury. And if it goes into a recession, if it's over a 12-month period, it becomes inverted. So as you can see, April of 2022, we did get an inversion in that. And again, what did I say a minute ago? That was the first sign of the first quarter of GDP being negative. So all of these things kind of are lining up to show that this could possibly be a recession. Now, as you can see, back to the 70s, anytime there was inversions, it was followed by a period of recession. History is pretty good about repeating itself. So again, another indication that we're possibly in a recession. Unemployment rate during recessions. You've all heard unemployment is at record low levels right now, which is a good thing, right? But normally, record low numbers go into signs showing that we're going into a recession. You can see it again. This was back to the 50s. Record low numbers, we had recessions. There's just documented times of it. I mean, there's several of them. Again, not each one of these are not a true indication by itself that we're heading to a recession period. But when you start putting these all together, it makes it look that way. Now, mortgage rates during recessions. The last recession we had, mortgage rates went from 3.75 to 2.75. Time before that, 6% to 4.875. 7.375 to 6.75. 11% to 8.75, 18% to 13%, and then 16% to 11.75. So as I was saying earlier, as the Feds put these funds up, trying to combat the inflation, which is again normally puts you into the recession, mortgage interest rates have responded pretty favorably to those in the past. Now, housing normally stays strong during the recessions too. As you can look here, back to the 60s. Anytime there was a recession, housing market went up. The only anomaly to that was back in 07, and that was the market crash, the housing bubble. That was a true bubble. You could get a mortgage if you could fog up a mirror and sign your name, and you didn't even really have to sign your name or all that, right? Just X. They were giving you a mortgage, and they were giving you as many mortgages as you wanted at the time. Underwriting isn't what it is today. So out of the 9 times that we were in recessions, 8 out of the 9, we did really well in the housing market. So This is another reason I'm going to go into here about we're not in a housing bubble. We're not going to see these markets crash, and this is why. Back in '07, when it crashed before, you can see the peak time, there was 3.7 million homes on the market. 3.7 million. Today, we're at 870,000. All right. So the inventory is record low right now. So again, totally different from what '07 was. Now, and you look at this here, the number of households. In '07, there was 116 million. In 2021, it's almost 130 million households. So again, you have 14 million more households with almost 3 million fewer homes on the market. These are all signs that we're not heading into any type of housing bubble. Now, we are going to have a rough few months, why the inflation is still rearing its ugly head. It's probably going to peak short term, but come back over the summer months before actually starting to go back down in the fall. Again, I'm Kenny Schaaf. I'm with Guaranteed Rate. And if you have any questions or comments, I'd love to hear back from you. Either reply to the email, shoot me a message, or just comment below, depending on where you're seeing this video at. Thanks for watching and have a fantastic evening. Bye for now.